LOS 21C. Describe the importance of financial statement notes and supplementary information, including disclosures of accounting policies, methods and estimates, and management's comment. There are two major financial disclosures which don't come under the balance sheet or income statement. They come actually after the balance sheet and income statement and statement of cash flows usually. The footnotes, the management's discussion and analysis, MD&A. The footnotes help us. The footnotes help us to understand company's position and performance. Footnotes gives us information about company's fiscal year, standards used in preparation of financial statements, accounting assumptions, insight about unique transactions, legal proceedings, employees benefits plans, contingencies and commitments. What are these? We will discuss later. Acquisition and disposals of business and segments of the firm. MD&A, also called management's commentary, management's report, operating and financial review. Remember, MD&A is generally unaudited. IFRS suggests the following items must be included in MD&A: nature of business, objectives of management, company's past performance, current business environment and future outlook, the performance measures used, the company's important relationships with suppliers and buyers, resources owned by the company and risks. US GAAP requires the following information: major events and future uncertainties. Major future events and uncertainties which will affect liquidity, capital resources and main operations of the business. Inflation and off-balance sheet items. Off-balance sheet items like operating lease, we will discuss them later. Obligations like payments, purchase or sale agreements or any other contractual agreement. Accounting policies based on management's judgment. LOS 21D. Describe the objective of audits of financial statements, the types of audit reports, and the importance of effective internal controls. First of all, what is audit? Inspection of financial statements and supporting documents by independent body is called audit. Objectives of audit. The objective of audit is to create an opinion about the fairness and reliability of a set of financial statements. The audit is done by auditor. Types of auditor's report: unqualified opinion or report, qualified opinion or report, adverse opinion or report. First of all, unqualified opinion or report. It is also called clean report. It suggests that the financial documents are free of any material error or omissions and financial statements has been prepared by following the accounting standards. Qualified opinion and report. It suggests that some exceptions have made to the accounting principles in preparation of financial statements. The auditor explains these exceptions in his report. This is semi bad report. Adverse opinion. If auditors found faults in the financial statements, like statements do not confirm the accounting principles or financial statements are not presented fairly, he issued adverse opinion or report. Effective internal control. It is the process by which firm tries to ensure the fair and accurate presentation of the financial statement. Internal control is the responsibility of management. They should keep checking the balances so the auditor can validate them. In USA, for the public traded companies, the auditor must express his or her opinion about internal control with or separate to the auditor's report. If you want to learn FRA easily, you can have my book by clicking on the link in the description. Thank you. Bye bye.